Hey everybody, back with another dividend analysis, and today we're going to be looking at Energizer Holdings Inc., more simply Energizer, or ENR. Wanted to take a look at Energizer because they're a household name, kind of an interesting thing to look at, and it pays a dividend, so why not? As always, we'll start by taking a look at the yield, currently sitting just below 3%, so you're going to be doing much better than, the wide market S&P sitting somewhere between 1 and 1.5%, doing easily twice that, so not too bad there. Nothing to write home about, but in such a low yield environment, 3% isn't too bad. Going back over the yield or the dividend history, we can see currently getting 30 cents a share, whereas 8 years ago we were getting 50 cents a share. So there was a big cut. The stock was halved in 2015. I did look to see if there was a stock split. I could not find one, though I could be wrong. I only checked 3 websites that track stock splits, so I could be wrong, but it doesn't seem like that was what happened. They did just cut it in half. We can see since then that they have been raising it very slightly, going up 2.5 cents, 1.5 cents, and then 1 cent, but it hasn't been raised since 2018. So there has been a little bit of growth over the last 5 years, but not a lot, and there was that huge cut. That is something to keep in mind. Know that if there is a problem, the company is okay with cutting its dividend. Just note that. They paid about $80 million in dividends over the last 12 months. So we're going to see if that's able to be supported by the numbers. Starting with the cash flow, we can see that they're currently sitting at $114 million. That gives us a ratio of about 70%, just under that. While not ideal, it is just in our acceptable range of under 75%. However, we can see that the cash flow has been very spotty and is overall down over the last 5 years. Going back to 2016, we're down a very good bit. They did have a great year in 2020, probably because people needed batteries for things at home, but that looks like it is a bit of, just a blip on the radar there, considering the year before doing less than 100 million. So this cash flow is very spotty. We do want to see this start to increase. If this continues to be spotty or goes down or even just stabilizes here, there are not going to be many dividend raises in the cards here. Looking at the income, we can see that currently at 160 million, a little bit better there. We're right at 50%, right at our ideal range. They're paying out about half of their income in dividends. That's very good. That means that they're very easily able to pay the dividend with the money that comes in. We can also see that their their income, while it is down slightly, not slightly, 20% over the last 5 years, it is up very much over the last couple of years. So again, it's a little spotty, but it is doing better than the free cash flow. Those should, however, start to normalize at some point. Hopefully, we can get a little bit better, more normal readings from those income and those free cash flow. Try to see if that dividend is going to be able to increase. Looking at those income and free cash flow numbers, we can tell why they haven't increased the dividend over the last few years. They really haven't been able to. It would have put more financial stress on the company than need be. So keep that in mind when looking at it, if you're looking at it yourself. What does Energizer do? They make batteries, pretty much it. Everybody knows what they do. Everybody's probably used an Energizer battery. Everybody's seen one. It's the market that they're in. Looking at the company, would you like to invest in this? Is this for you? It's very iffy. From the growth side, there was that big cut. That's very rough. 50% dividend cut is rough, especially one that recent, only being about 6 years ago. From the income side, it's okay. 3%'s all right, but there are plenty of 3% companies that are raising their dividends, that have better free cash flow numbers, that have better ratios, stuff like that. This is definitely an kind of stock when it comes to a dividend choice. From the valuation side, they're probably right where they're supposed to be. It's a large old company. It's a multi-billion-dollar company. The PE is sitting around 20. Your yield's around 3%. It's probably going to sit right around there. There's probably not a lot here. This might be something just to add if you have a wide market, portfolio with a bunch of stuff that's 2, 3, 4%. This might just be thrown in there for diversity. If you're looking for something, if you really want to invest in batteries and you're a dividend investor, here you go. Besides that, there's not a ton here. There's better choices out there that have similar numbers or better numbers while giving you a similar yield. So yeah, it's not a bad company by any means. They still make money. They're still generating free cash flow. It's just very spotty. It's hard to see where those numbers are going to be. We really need to see those numbers normalize to see any kind of dividend increases or anything like that. Until something like that happens, I would personally tend to pass on something like this just because there's better choices out there. But of course, do your own research, see what you like about it, if there is anything. And if you do, that's up to you. But aside from that, yeah. Thanks for watching, and I'll see you next time.